Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a true oil, natural gas, and energy expert. He's been covering these stocks, oil and natural gas stocks, for over 20 years. He runs with Roger Conrad. He runs the Energy and Income Advisor. They have a handful of oil and natural gas paid investment newsletters, including dividend stocks, producers, and some of these master limited partnership ones that are pipeline companies. Elliott Gue, thank you for joining me again.
Thank you very much for having me on the show.
You're very welcome. And I really enjoyed this discussion and consider you a friend. We were actually talking for about 40 minutes about the energy market. It's just so wacky right now. It seems like this new story that came out a couple days ago from the Financial Times are reporting this that the Saudis may have done a 180 on their oil strategy. By the way, for our audience out there, we're recording this interview on Friday, September 27th, 2024. West Texas Intermediate crude oil prices are down at the lower end of a trading range, down to $68.18. The natural gas price has rallied quite a bit over the last couple months. It's just below $3 each at $2.90. I think it was stuck around $2 for months. I want to get your thoughts, though, on the story that's come out in the last couple of days. The Financial Times is reporting that the Saudis have done a 180 on their energy strategy. So for our listeners out there, for the last year or two, the Saudis have been trying to keep prices above a certain level. I would say or $70, $75 or more. Do you think the Saudis are actually doing a 180, or do you think that this story is kind of misinformation out there?
I don't buy the story, actually. I've OPEC over the years, we've been through several different cycles, of course, for energy and for oil. And OPEC, like all cartels, they're very good at controlling demand side shocks. So, in other words, in a recession, OPEC cuts their oil production, cuts oil supply, and prevents the world from basically building up large inventories of oil and related products and refined products. And that keeps the price of oil from collapsing too much. But a cartel and, OPEC and particularly Saudi Arabia, who has really one of the only OPEC members that has a history of managing their actual production according to what they agree to do, right? They can't really address supply side shocks. So if the price of oil is down because there's too much supply, so you have too many non-OPEC producers dumping supply into the market, if the Saudis cut production, then they're just going to lose market share because the other producers are going to keep filling in that extra supply. And so, I think what the Financial Times article is referring to, or what they're suggesting, is that we're in a position today, much like we were 10 years ago in 2014. And, back in 2014, I can remember being very, very bearish on oil. And the reason that I was bearish on oil was that you had, the US shale producers in particular growing production like crazy. And, we were talking a little bit about this offline, but you had capital markets, both the debt markets and equity markets, that were rewarding these companies for growing production. So you saw stock prices highly correlated with a company's ability to grow barrels coming out of the ground. You had companies that were out there that were not generating enough money from their operations, their actual oil and gas production, to fund their drilling, their capital spending. So they were borrowing money in large quantities. Some of these companies, Chesapeake, for example, ended up going bankrupt because they borrowed so much money to fund their expansion. And so Saudi Arabia, under their previous oil minister, Ali al-Naimi, they realized that the more that they cut production and propped up the price of oil, and if you remember back then from 2010, 2011, all the way up through late 2014, oil was very stable around $100 a barrel. So you had, spikes up to 110, 115 and pullbacks to 85, 90. But every time that happened, it would kind of revert right back to that trading range. And they realized that by doing that, by the Saudis restricting their own production to keep the price of oil around $100 a barrel, they were essentially financing the entire shale boom. Those high oil prices were what was encouraging these companies to drill more. It was why the capital markets were just so wide open to their production growth. I remember doing a study back then where I took the 3-year production growth for all these energy companies and compared it to their 3-year trailing stock performance. And it was a very close correlation. And so the Saudis realized back in 2014 that by keeping the price of oil high, they were encouraging this new supply. Every time they cut oil production a little bit, these shale producers would fill in that gap with more supply. In the first 11 months of 2014 alone, U.S. oil production grew by 1.35 million barrels a day. In the first 11 months of 2014 alone. Look at shale production growth from 2010 all the way up through late 2014, and you'll see that there were years where we were adding more than 1.5 million barrels a day to U.S. oil supply. And they realized that, by propping up the price of oil, they were just going to continue to lose market share. They were going to have to cut their production more and more and more just to artificially prop up the price of oil. And, there's no point in that. They can't control the price of oil when the problem is supply just growing too fast, because if they prop up the price of oil, they're just going to encourage more supply. The
Now that's
problem
in the
today,
hindsight. That's in the hindsight, though, right? So now things are different, though. There's not as much tier one acreage. There's not as much capital available in the Permian Basin. There's pipeline capacity issues. So there's a lot of additional problems that were not the case back then.
that's absolutely right. The problem now has nothing really to do with supply. It's really a demand issue. We've had weaker demand from places like China that have helped push down the price of oil. The supply side, so far this year, in the first 6 months of 2024, for which we have data from, the Energy Information Administration, U.S. oil production is actually down through the first 6 months of this year. That was not the case in 2014. U.S. oil production isn't growing, hasn't grown much really since late 2022. So it's not a supply-led problem this time. It's a demand issue. Some countries, China, Europe, for example, have seen weak demand growth mainly because of weak economic growth or underperforming economic growth relative to what a country like China did, say, 5 or 6 years ago. So the Saudis, I don't think, are likely to respond in the same way they did in 2014. The reason they increased production and allowed the price of oil to fall in 2014 was because they were facing a threat in terms of supply growth from keeping prices too high. Now supply growth, the non-OPEC supply isn't really growing. You have only a few places that are showing real growth. You have Shale, but it's very slow growth. You have Guyana, right, which is in South America, and you have Brazil. But those countries, the projects there are primarily led by large international producers who are going to produce those projects, develop those projects, whether oil is at, $45 a barrel or $100 a barrel, right? They're not particularly price sensitive. They're going to develop those projects anyway. And for the most part, those projects are simply offsetting production declines from other non-OPEC countries. So I don't think you have a supply problem. I think you have a little bit of a temporary cyclical demand problem. And so I don't see the Saudis responding to that by increasing their production and flooding the market with barrels of oil into a squishy demand environment, right now. Then, as you alluded to, in the U.S., I think there's a misunderstanding out there. You have a lot of people thinking that, U.S. shale production is going to grow as it did back, 10 years ago, or even a few years ago, in 2018 or so. And that's just not the case. I mean, we're seeing flat to declining production. We're seeing it become harder and harder for these companies to grow their output. We're seeing a lot of companies talking about the percentage of oil that comes from their wells, their oil cuts, being lower than it was a few years ago, more natural gas. A lot of producers that I follow, they have limited inventory of prime acreage. And as they drill through that prime acreage over the next 10 years or so, they're going to have to moving more and more of their operations to secondary acreage, which is much more expensive to produce. I think that Yeah, the other factor, which again I don't think gets a lot of attention, but should, is that previously you had a lot of small independent producers and even private producers in places like the Permian Basin. Increasingly, that's no longer the case. You have a lot of consolidation. You have Exxon, Chevron, Occidental, a few big producers, right?
Conoco just
And
bought Marathon. Yeah. So there's a lot of mergers and acquisitions. I'll ask
a
you.
ton. Yeah, and that means that and those producers are much more disciplined, right? Exxon isn't going to dramatically increase their production growth because the price of oil goes up to $100 a barrel versus 80 or 70. They have a long-term development plan. If you look at their long-term plan and read their annual investor day reports and whatnot, they're looking to ramp up production in a place like Permian Basin to a sustainable level and hold it there for as long as possible. They're not going to rapidly increase production if the price of oil goes up because that's not how they do business. That's how small independent companies in the early days of the shale boom did business, but that's not Exxon's business. They're much more about sustainable long-term production, maximizing free cash flow, not maximizing barrels coming out of the ground. And if you're facing a world where shale production is at or close to a peak, and again, by that peak, I don't mean that production is going to fall 1 million barrels a day. I'm talking about a plateau of production that may be, 500,000 barrels a day higher than we are now, maybe not,
So it
right?
stays in a certain range then. So give or take, it'll stay in a certain production range. So what the U.S. is, are they the world's largest oil producer now?
Yes,
So
yes, we are.
we can keep it kind of in a range then, plus or minus like 500,000 barrels per day. But I think the point that Elliott's trying to make, and Christine Guerrero, who I've interviewed in the last petroleum engineer, she's talked about this a lot. The analogy is it's either a hamster wheel or a treadmill, that it becomes more and more expensive to keep production at those levels.
Yeah, it becomes very, and that's an apt description. It's one I've used too in the past, the treadmill description, because shale wells have a very high decline rate. So, meaning that in the first year of production, in some wells, you can see a production decline 50%, 60%, right, from the initial production rate. And that's how shale wells work. And there are things you can do to, extend the plateau on a shale well. You can go in and refracture shale wells. They're certainly getting much more efficient at drilling, different well designs that maximize production flow. But when you want to grow production as a shale producer, you not only have to go out and drill new wells, you have to go out and drill just new wells just to offset production declines from your existing base decline, right? What we call base decline, basically the natural decline in production from your existing drilled wells, right? Then you have to drill more wells to add production growth. So it's very complicated and very drilling and capital intensive to grow production at a high rate. And at some point, when your base of wells that are in decline is high enough, when the price of oil doesn't support drilling particularly aggressively or outspending your cash flow, it becomes very difficult to grow your production by a great deal. Now you can, like Exxon wants to do, like Occidental wants to do, like a lot of these producers want to do, these larger producers, they want to get up to a plateau and hold it there. That's certainly possible. And I think the US could produce enough oil to meet a lot of its own domestic needs on the oil side for many years to come. But the idea that's out there, that's implied by the FT articles and others that, there's going to be very rapid growth in shale oil production, such as we saw back in 2014, that the Saudis are going to want to squeeze out of the market, it's just wrong.
Yeah,
Um,
it sounds like we laid it out. Elliot laid it out over the last 15, 20 minutes. It sounds like there's a lot of reasons why this is not 2014 all over again. There's also not the pipeline capacity to rapidly increase production. So the pipeline capacity has to come online. The pipeline capacity is not there. The cost of capital now is way higher than the past, and the tier one acreage is not available. So once you already hit what is 13 million barrels per day the U.S. is producing oil, it becomes tougher and tougher to increase it.
That's right. And and if you look at it, if you look at the data from the EIA, and there's some issues with the data, which is that they changed the way they account for production about a year ago, back in the summer of 2023. But even if you look at their data and take it at face value, oil production hasn't really grown much since the 2019 2020 peak. We saw oil production come down sharply during COVID, and then we saw a recovery, but we're basically hovering around the same level we were 4 years ago. And, oil production is up, I think on their numbers, something like 150,000 barrels a day since late 2022. That's flat production in my book. When you're talking about a country that's producing over 13 million barrels of oil a day, 150,000 barrels a day over, basically 2 years is nothing. So, again, it isn't 2014. Saudi has, this is not a new thing for Saudi Arabia. I think we talked about one of the last times I was a guest on your show, back in the 1980s. Saudi Arabia went through a very similar issue to what they had in 2014. Back in 1985, 1986, non-OPEC production was growing very rapidly, mainly because a lot of companies had invested significant sums in oil production and development during the 1970s and early 1980s because the price of oil was very high.
The two major fields back then, wasn't it what the North Sea in Europe off of England and Norway, and then also what in Alaska? Those were the two major field growths.
Yeah, you had that, and you also had Cantarell, which is a
Oh
shallow
yeah,
water.
Mexico, Pemex,
Yeah,
yeah.
yeah, and they developed that and ramped it up very rapidly in the late 70s and early 80s, and really that was why prices came down. A lot of people think the price of oil came down because the Fed hiked interest rates a lot, but if you look at it, demand growth was actually pretty strong in the late 70s and early 80s globally, right? Despite high interest rates in the United States. The bigger reason why oil prices came down in the early and mid 1980s was because you had a surge of non-OPEC supply, millions of barrels a day of non-OPEC supply, which basically offset OPEC's efforts to control their own supply and prices. So you had what happened was is that when OPEC started jacking up the price of oil in the early and mid 1970s, like 1973, 1974, right? You had a lot of the US producers and European producers that were the big international producers of the day. They really weren't spending very much money on exploration and development. They were relying on this plentiful, low cost supply from Saudi Arabia and other OPEC countries. And when OPEC started flexing its muscles, their response was to spend more money on exploration and development, which makes a ton of sense, right? I mean, if the
Well, the
price of oil
market sends
goes
a high
up,
price, right? So if the market sends a high price and it stays there for a while, that's a signal to the producers that they can look to find new supply.
it's exactly right. And the oil business is the market speaks through price, and any commodity business is like that. And it spoke, and they listened, and we saw an increase in production. And by 1985, 1986, the increase in production was so great that Saudi Arabia realized that they were continually cutting their production. Almost every quarter, they were cutting their production to prop up the price of oil. The price of oil was sliding anyway, and they would cut production a little bit more. And so finally, in the mid 80s, they came out just like they did in 2014 and said, "We're going to produce a lot more oil. We're going to let the price of oil fall. We can't control it anymore." Price of oil collapsed,
And
and
you bankrupt the higher cost producers then, right?
you bankrupt the higher cost producers. And back in those days, I mean, one of the big things was you had capital dry up for all this non-OPEC development. So a lot of these producers that were spending a lot of money developing these new fields all around the world, developing new technologies such as drilling offshore, which was relatively novel at that time. They couldn't afford to spend as much money on drilling and production, and so their growth rate declined. And so supply became less of an issue. I mean, it took a long time for the market to heal because supply shocks always take a long time to heal. And very much like what we saw after 2014, right? Price of oil collapsed. We saw a low in 2016, somewhat of a recovery, and then a second low, even lower low in 2020. We had a 6 year long bear market nearly in oil um, before we finally got a bottom and the beginning of a new upcycle, because that's how long it took to break that excess supply. That's how long it took to finally bring the shale producers kind of into better alignment. But that was the situation 10 years ago. That's not the situation today. Today, we just don't have that kind of nine OPEC supply growth. So I think the argument from the FT and from others we heard this week, I think Bloomberg had a story that was along the same lines in light of the FT's article. And it doesn't add up in my view. I don't think that the Saudi Arabians are going to respond like they did in the mid 80s or 2014 to a demand shock. That's how they respond
The
to excess supply.
I think also the Saudis don't care as much about trying to gain market share as they care more about remaining profitable. They don't want the oil price down at $50 or lower because at this point, with inflation the way it is all over the globe, and I think a lot of people are well aware that the real inflation rate is still above what the governments are saying the inflation is, and everyone's been dealing with accumulated inflation now for 5 years, especially for oil drillers and all these other businesses that they don't want to be in an environment where they're losing money, saying producing at $50 a barrel, even if they're the lowest cost producer. Some of their wells are going to be very profitable, but other oil production that they have is not going to be profitable. So that industry then really can't afford lower and lower prices like that. Maybe temporarily they could, but we're looking at an environment where for supply to just be maintained, we're going to need higher price floors going forward.
Yeah, and I mean that was another thing in the FT article. I mean they referenced that OPEC had an unofficial target of $100 a barrel, which isn't true. I mean they don't have a target, unofficial or official. What they do target is global inventories of oil, right? So they're looking for global oil inventories, the amount of oil in storage around the world, not to get too lean such that you risk price spikes, but also not to get too bloated, which means that even when the global economy recovers and demand recovers, you have all that excess supply to work through that's just stored. So they're targeting global inventories, not really prices. Um, the Saudi Arabians long term need 90 to $100 a barrel Brent to fund all their social spending, domestic social spending, but they can certainly support oil prices lower than 90 or $100 a barrel for long periods of time. They have access to debt markets, et cetera. They can issue more shares of their national oil company, Saudi Aramco.
They have
So
a sovereign wealth fund too, a giant one.
they have a giant sovereign wealth fund. They have lots of levers they can tap to handle lower prices for a period of time. Um, Now, longer term, yeah, I think that Saudi Arabia probably will want to see over the course of a cycle prices average above that 90 to $100 a barrel region. But again, that brings us back to the same thing. Why would they want to drive down the price of oil today, right? Knowing that they could just and produce more oil today at low prices, knowing that probably a year or two from now in a more normal economic environment, they're going to be able to produce that oil and sell it at a much higher price. It just doesn't make sense. The only reason they would want to increase their production is if they felt threatened on the supply side and they wanted to squeeze out high cost producers. But again, I just don't see that there are any high cost producers to squeeze out. Shale production, as we talked about, is probably going to plateau, even fall a little bit. I think if oil prices remain where they are today in the low 70s or high 60s, right, you're going to see, and I'm talking WTI versus Brent, you're going to see, U.S. oil production probably fall. These companies
And
don't want to produce more aggressively at this price.
especially with the mergers and acquisitions too, to add to your points there, because there's been what, over 230 excuse me, over 230 billion dollars worth of mergers and acquisitions in the last 18 months in the US and Canada, mostly in the Permian Basin, but also in Canada and other areas. And I would argue once those companies are consolidated, they're not planning on rapidly growing production once the consolidation is done. It's what, why do you think the so many deals? Is it mostly to make sure that the company maintains drilling inventory?
Yeah, that's exactly what it is. Access to resource. If you look at a company like for example, Exxon bought Pioneer, right? They announced a deal about a year ago. I think it was October of last year, and they closed the deal earlier this year once they got through all the antitrust stuff, right? But they bought Pioneer because Pioneer owns some of the prime acreage, particularly in the Midland Basin of the Permian. The Midland Basin is the part of the Permian that's totally in Texas, right? Um, Exxon has acreage there. They also have acreage in the Delaware Basin, which is part of the Permian on the border of Texas and New Mexico. And Exxon wanted to shore up their acreage position in the Midland Basin, right, where they had less. They wanted to secure years of inventory, probably 15 or 20 years of drilling inventory of prime quality plays. There just aren't that many companies out there that have that kind of inventory. Pioneer was one of the only ones. Pioneer itself had been a major consolidator in the years leading up to that deal. And they built up a massive acreage position. They built up infrastructure. You were talking about pipelines, but also, water recycling facilities because it requires a lot of water to fracture an oil well. Access to, sand for fracturing wells. The know-how and knowledge of the best well designs to drill in a particular region of the country. Yeah, they bought them for access to resource. You had Occidental buying the Crown Rock, which was a privately held company. Again, access to drilling locations and inventory. And that's it.
And Conoco just bought Marathon Oil recently too for what, 20 billion or 30 billion, something like that.
Yeah, I mean, these are huge deals. Again, it's all about, and if you look at these companies' plans, in a lot of cases, one of the things we saw was that in the first half of last year, a lot of these private companies were ramping up their drilling activity. And the reason they were doing that was because when you're a private company producer and you get acquired by a company like Exxon or Conoco, usually you get acquired based on some value per flowing barrel of oil, right? Or flowing barrel of oil equivalent. So it's based on your production and also the amount of acreage you have, right? So these producers wanted to dress themselves up for sale. So you saw them all drill aggressively so they could increase their production in the first half of 2023. And then once they got their production up, they were able to sell for a higher valuation. Once they got acquired, though, immediately the acquiring company drops rigs, right? Slows down drilling activity. They're not looking to grow production at 1 million barrels a day every year or something of that nature. They're looking to get to a stable plateau of production that they can sustain on a particular level of capital, and they could generate a particular level of free cash flow from that acreage.
And that's important because that's much different than 2014 environment that you described.
Yes.
So I want to read this quote because I think it's important. There was an article that came out in the oilprice.com from Irina Slav, who's an excellent oil analyst and writing these articles for many, many years now, from September 24th. Quantum CEO claims the shale revolution is over. William Van Lowe, who is the chief executive officer of Quantum Energy Partners, he told Bloomberg over the last week, the U.S. shale revolution has run its course. He said, clearly the investors have put oil and gas companies on a very short leash. They've required a massive amount of the cash flow every year to get returned to shareholders. Investor demands for fatter dividends and share buybacks is one of the major reasons, the slower supply growth prediction. The other reason is the end of the shale revolution. He said, look, We've tripled oil production in the last 15 years in the United States, mostly because of the Permian Basin, and doubled natural gas production. He was like, how much more can we keep growing at those types of paces?
Yeah, absolutely. And it just goes back to, what I was saying about the difference between now and 2014. Um, and another one to kind of add to that is that, right now, if you look at the futures markets, um, your speculators are very bearish on oil, right? So you have the lowest net long position in Brent crude oil in over a decade, right? Since I think 2011. WTI, their current futures market positioning, their net long position speculators now is about two standard deviations below the 2-year average, right? They're more bearish on oil based on their speculative positions than they were in 2020, right? When the price of oil collapsed amid the global lockdown recession. So the Saudi, and back in 2014, it was the opposite. You had a lot of future speculators betting on higher oil prices, not lower oil prices. The Saudis monitor all this very carefully. They're always referencing the speculative position in the futures market. Um, in my mind, they would be crazy not to take advantage of that. All it will take from them is a short, sort of lengthening of the production pause or the production cuts they have in place, maybe through the first or second quarter of 2025. And you would force a lot of the speculators to cover their short positions and drive the price of oil higher. They've done this literally half a dozen times since 2020. When those speculators get too short, they come out and announce something to drive the price of oil up, force the speculators to cover. To me, that article made no sense when it's released. And again, I'm not a perma bull on oil. Back in 2014, I remember getting hate mail telling people to sell some of these energy stocks. But now it doesn't make sense to me. And if you read the FT article, I think they referenced anonymous sources familiar with the thinking. I don't know what that means. I don't know who they spoke to.
It
I don't
sounds
know
like
how.
it sounds like something to put out there to get oil prices down before the election. Honestly, it sounds like misinformation that's kind of politically driven or election driven. Because here we are, where people are going to be sending in their mail-in ballots or about to vote, and the politicians want oil and gasoline prices as low as possible before the election.
It could be. And, if you think about it, the Saudis and others, they don't have to they've extended the current level of production cuts through December to December. So they don't really have to make a decision on whether to extend those cuts for longer or not until they meet in November. They need a few weeks, right, um, to decide how much oil they're going to produce in a given month. They can't change, day to day. But certainly, they could wait until after the election, which is in early November, right, a little over a month away, to make a decision like that. They don't have to say anything positive or negative about oil in the short run. They don't have to make any concrete decisions. So it's kind of, if you were looking to manipulate the price of oil using a news story, it's probably not a bad time to do that because the market's very negative on oil. There's lots of concerns swirling out there. But to me, fundamentally, it doesn't make sense. And it doesn't make sense in particular for the Saudi Arabia. And, Saudi Arabia, people act like they're kind of random in the way they do things, but they're not. If you look at it back in 2014, they talked about this very problem of excess shale production for over a year prior to doing anything about it. It wasn't a surprise at all. And
And the
that's why I got
capital
so
kept flowing. Yeah, 2014, the capital kept flowing. I mean,
yeah,
we've discussed this in prior interviews. I've discussed this with Josh Young, the oil hedge fund manager. I mean, the capital kept flowing into the sector. It was drill, baby, drill. They
yeah.
weren't focused on free cash flow. They weren't focused on share buybacks for a cheap valuation or paying dividends. The industry, people running these companies, they seem way more focused now on being more disciplined, at least for the time being, buying smart assets in mergers and acquisitions. If the valuation is cheap, paying more dividends, doing share buybacks if they think their stock is cheap. They seem more focused on taking care of their shareholders rather than growing drill baby drill.
Yeah, and back then, I remember I was tracking literally dozens of small producers. Also, I was tracking in various ways, private producers back at that time. There were, you had a lot of small players in a place like the Permian. And even the companies that later became really big, like Pioneer, they really weren't that big back in, 2011, 2012, 2013. I mean, this thing was just getting going in terms of the shale boom. So a small company is going to tend to be more growth oriented, right, than a big company like ExxonMobil. Why does somebody go out and buy ExxonMobil, which I think is a great company, by the way, recommend it and Energy Income Advisor. But you go out there and buy Exxon because, it's got a bulletproof balance sheet. It's got a decent dividend, right? They generate a ton of free cash flow, right? You don't go out and buy it because they increase their oil production by, 100,000 barrels a day this quarter. It's just a very different equation, and it's a very different value proposition to say a small producer in the Permian, 12 years ago.
Do you expect producers like ExxonMobil and Chevron that are the lowest cost producers, do you expect them even in this environment where oil and gas prices are kind of trending at the lower end of a trading range to remain with good amounts of free cash flow and to keep growing dividends?
Yeah, because Exxon, most of what they've done over the years is they've done what they call high grading. So a lot of their higher cost sources of oil and gas around the world, they've divested those assets, or they're winding down those assets, usually some sort of divestment, and then they use the capital that they generate from selling assets as also free cash flow that they generate from their base business. They plow that right back into new low cost projects. So you look at a company like Exxon, their crown jewel is Guyana, right, in South America. Most of those wells in Guyana can generate positive free cash flow on an ongoing basis at $30 a barrel oil, $35 a barrel oil. You look at their operations in the Permian Basin, and given the scale they have in the Permian Basin, a lot of those projects would also be profitable, and they've said those projects would also be profitable at that same sort of level, somewhere between, let's call it $30 and $40 a barrel. So they can generate free cash flow at very low oil prices. And remember, this is something that they have done for decades. You go back to the 80s or 90s and you read, development plans or annual report from a company like Exxon or Chevron, and you'll see that their long-term oil price assumptions were usually very low oil prices. Back then it was probably the teens a barrel, which on an inflation-adjusted basis is probably more like $30 or $40 today. But they make it a long-term assumption about oil prices over the next 5 or 10 years, and they only go ahead with projects that can produce oil profitably at those low or modest prices. And they don't make quick drill or no drill decisions based on short-term oil price fluctuations. If you remember back in 2020, Exxon came under a ton of fire in the mainstream media for continuing to invest in Guyana, right, when the price of oil was low.
But they also borrowed a lot of debt. So we've discussed this in prior interviews. If our listeners want to go back, I mean, I was worried about it at the time because we didn't know what the future was going to be. But in hindsight, I mean, Exxon was really smart. They borrowed a bunch of cheap debt because they had cheap cost of capital. Yeah, they borrowed all that debt when in 2020 during the pandemic at an artificially cheap interest rate. And then they used that for growth, and they paid off the debt pretty quickly in about 2 years. Most of the net debt was gone.
A lot faster than most people imagined. And, then the companies that were being held out as examples of what to do at that time, if you remember, there was an activist campaign against Exxon. BP was spending all this money on, alternative energy developments, and they still have a huge debt problem that's just magnified over the last 4 years. I think their dividend ultimately will be threatened if things don't improve there.
You're talking about BP. You're talking about
BP's
yes, dividend.
Yes,
okay.
BP, yeah, Exxon. Basically, Exxon did what it always has done, which is that when the price of commodities is low, they invested because when the price of oil is low, your costs are lower. Everything from labor to materials to oil services work. Also, if you're going into a foreign country and trying to cut a deal with the government there or the national oil company there for access to resource, you're going to get a lot better deal when oil prices are low than when oil prices are very high and everybody's bidding on the same contract. And so they took advantage of that down cycle to invest. They had the low cost of capital, as you referenced. I mean, they were borrowing money at nothing, right? Their corporate
2%
bonds
or
back
something.
then.
Yeah, it was
It was
very cheap.
insane. It's like most governments have, through history, have not had access to capital at that cost. And they were borrowing all this money, using it to buy assets or develop projects on the cheap, and it's paying off when you get the next inevitable upcycle. And I remember them talking about it back then. Oil business is cyclical. You invest in the downturns, you generate tons of free cash flow in the upturn. If you don't invest in the downturn, then you have declining production when the cycle turns, and you're bidding against everybody else
Well,
for
that assumes you
assets.
make smart investments with your with the
Right.
debt and the cash flow, because like BP has invested in wind, solar, biofuels, and now you have problems. Now you have activist investors going in there trying to take board seats. I think the activist investor said they are now they want anti ESG policy now, so they want to only focus on projects that can definitely return positive capital, like liquefied natural gas, oil projects. And so those wind, solar, biofuels projects that BP has been investing in for the last 15, 20 years that have either gone bankrupt or needed bailouts and stuff, they're going to be phasing those things out.
Yeah, I mean, BP on their last conference call, the new CEO who took over a little over a year ago, I believe, he or about a year ago, he was talking about their developments in the deepwater Gulf of Mexico, and BP has a lot of wells, a lot of acreage in the deepwater Gulf of Mexico. They have new developments they can undertake there. They're starting to put a lot more capital there. They're good at that in terms of generating free cash flow. That's their core business, is developing oil and gas. And I think they've done a lot to address some of their previous sort of safety concerns, because you remember they were responsible for the oil spill in the Gulf, back 2010, I believe it was. But that they're good at that in terms of generating free cash flow from it. They got into a bunch of businesses, wind generation, biofuels, that they didn't know what the actual return on investment was going to be. They still developed it aggressively, and the return on investment was a lot lower than they assumed. So now they're shifting capital back in favor of their base oil and gas business, and that's the right move. My only problem with BP is that, um, is it
They're
too late? Are they now pouring money into the oil and gas business, but they've already built up too much debt. They're too far behind the curve
they're higher
in terms
cost
of
too. The
their
last
higher costs. Yeah.
I haven't looked at BP in a couple of years, but the last time I looked, I mean, they were way higher cost than Exxon, Mobil, and Chevron for production costs.
And some of that is where they operate. Traditionally they've had a lot of business in the North Sea, and those wells are becoming higher cost to produce. But yeah, I mean, they just didn't invest much in the depths of the downturn, and now they're struggling to play catch up with a name like Exxon or Chevron, even, who invested a lot more in the downturn, and now has more attractive suite of projects.
And also, BP has all those losses on wind, solar, biofuels. So that could have been free cash flow or cash on the balance sheet, paying off debt that they could have used. And so, shareholders, the problem with that is shareholders still, the pension funds and the other large investors that own BP shares for the last 10, 15 years, they still wanted the dividends paid. But BP, the underlying business, was losing a lot of money on a lot of their capital allocation for these ESG projects, wind, solar, biofuels. So that was a problem. So you had
Exactly. They
shareholders.
starved they starved their fossil fuel business of cash, to fund these other projects, and it just didn't pay off.
So I want to ask you about opportunities in this environment for risk reward. It sounds like in the short term, maybe until the election's over, oil prices are going to remain in a trading range or weak. Maybe after the election, we'll start to see a rally in oil prices. In this environment, do you think the opportunity then is for some of these low cost producers that can grow dividends, Or do you think it's maybe for these infrastructure plays like the pipeline opportunity? Seems like the pipeline opportunity, these liquefied natural gas exporters that can take the cheap natural gas here in the United States and ship it to Asia or Europe for a much higher price point, or the pipeline companies that are going to build these pipelines in the Permian Basin for natural gas and oil to move it to maybe those ports to export. It seems like the pipeline companies might be a great opportunity.
Yeah, I actually think there are opportunities on all those areas you mentioned. We've liked for many years and followed for many years a lot of the what we call midstream companies here in the United States. These are the companies that own pipelines, they own natural gas processing facilities, they own export facilities for oil and natural gas and refined products. Many of them are pay very nice dividends or distributions if they're master limited partnerships. Many of them are still, and because their base business is very free cash flow positive. It doesn't matter as much to them what the price of oil or natural gas liquids is at any given moment in time. It matters more to them the volume of oil, gas, or NGLs that are moving through their system. So they have less, commodity price sensitivity. So sometimes when commodity prices are, very weak, or volatile like they are right now, this is a good place to go because you're not going to get all the benefit that you're going to get out of an oil producer if the price of oil and gas goes up a lot. But it's a nice steady cash flow play, and it's a very real need. Infrastructure is crucial to producing more energy. And a name I've liked for many years is Enterprise Products Partners. Symbol is EPD. There has a 7% yield right now. It is a master limited partnership, but um, they own. One of the things I really like about them is they have focused now for many years on the oil and gas export opportunity, right? And in particular, natural gas liquids too. So they realized years ago that the U.S. was going to become a bigger and bigger exporter of hydrocarbons. In their case, natural gas liquids being a major one, things like propane, ethane, and which are used in the petrochemicals industry around the world. We're the largest exporter of both ethane and propane in the world. Nobody talks about these hydrocarbons. Mostly people talk about oil and sometimes they talk about natural gas. But there are these other hydrocarbons out there, which are produced in shale wells around the country, both oil shale wells as well as, of course, natural gas shale wells in certain parts of the country. And, Enterprise built up a lot of infrastructure involved with exporting these products around the world. And that's going to be a growth business because as we talked about, there are not a lot of places in the world which are seeing strong growth in hydrocarbon production. Natural gas liquids, the United States is very much the Saudi Arabia of natural gas liquids.
And
Ethane
cheap
and
natural
propane
gas too. I mean, like we're
and
going to
cheap
be.
natural gas. Yes.
Are we
Yeah,
we're number one or number two
we
for
are.
liquefied natural gas
We
exports
are.
right now?
We are. I believe as of the end of this year, we're going to be number one for LNG exports. For many years now, we've been the world's largest producer of natural gas. And that's another that's a market that's going to grow, and you can also play that I think longer term on the producer side. Natural gas prices, as I think you alluded to earlier on, have been very depressed now for some time. We've seen little rallies, based on weather conditions and whatnot, but for the most part, natural gas prices have been pretty depressed
Well,
since
that's in the U.S., right? So there's
in the U.S.
there's
Yes,
huge profit opportunity if you can get that cheaper natural gas here in the U.S. You can get it via pipeline to a liquefied natural gas exports facility and then resell it to Asia or Europe. Though the prices are way higher.
that's correct. In Europe, at times, you were looking at 10 times the price for a gas that we were paying here in the U.S. And you think about it, Europe, they can't import gas from Russia, right? Like they used to account for most of their supply. They're going to have to get it from somewhere else. And I think what you're seeing more and more is not just in Europe, but all the way around the world, people are starting to notice after the Russia Ukraine um, conflict and subsequent disruption of Russian exports, a lot of countries are realizing, it's not good to have your only source of supply be one country. So, you have countries like Japan, for example, that have to import a lot of natural gas. They want to import from the US. They want to be able to import from Australia. They want to be able to import from the Middle East. And the US, as the largest player in this market, is going to be, I think, in the catbird seat for many years to come, because, we have the largest production of natural gas in the world. We have the cheapest to produce natural gas in the world, or among the cheapest produced natural gas sources of natural gas in the world, in the form of shale fields like the Marcellus Shale in Appalachia or the Haynesville Shale in Louisiana, which has the additional advantage of being located right next to all the LNG export terminals on the U.S. Gulf Coast, Louisiana and Texas. So, I think there's a lot of opportunities there. One name I'd throw out there is Chesapeake Energy. The CEO of Chesapeake Energy just came out a few days ago and said that they announced a deal to acquire Southwestern Energy back in January, but both Southwestern and Chesapeake subsequently got a bunch of document requests from the FTC, which, as you probably know, is a very activist Federal Trade Commission, which delayed the deal. But the CEO said that early in the coming quarter, so next month is the start of the fourth quarter, right? They would close the deal with Southwestern, which will make them the largest natural gas producer in the United States. And also with access to the two most important plays in the U.S., which are the Marcellus Shale, which is Appalachia, places like Pennsylvania, West Virginia, right? That is the cheapest source of natural gas in the United States. But of course, to get the natural gas from Appalachia to the Gulf Coast, you have to have access to pipelines, and there are not that many of them, and
Well,
they're full.
let me bring up that the CEO of EQT, which is operating out of the Marcellus and Utica, he said that he actually doesn't want to pipe the natural gas down to the liquefied natural gas export terminal facilities. He wants to bring it down one state here to Northern Virginia for all the data centers that they're going to build. So he thinks that's cheaper and easier just to bring the pipelines down one state to the Northern Virginia area for all the next generation data centers for artificial intelligence.
Yeah, I mean, I think what you're going to start to see more and more of is that Marcellus gas is going to be used by nearby states, Virginia, North Carolina, and then all the way down the East Coast. Florida, here in Florida where I live, we use a lot of natural gas. We don't produce any natural gas in state. And I think a lot of that Louisiana gas is what's going to end up being exported because it's so located so close to the Gulf Coast. You don't have to permit, a massive interstate pipeline. You don't have to permit a massive interstate pipeline through heavily populated areas,
Or
right?
through multiple states, yeah, 4, 5, 6 states. I mean, if you're just
Right.
moving it like one state over, so like if you're on the West Virginia Pennsylvania border and you only have to move it down to Northern Virginia, that's not many miles there. But you have certain states like I think New York, New Jersey, Massachusetts, they block pipelines going from what the Marcellus and Utica Shale. They won't allow it. So I mean, they could easily build a pipeline if they wanted to. It's just the politicians and bureaucrats and environmentalist lawyers, ESG lobbyists that are blocking all those things.
Yeah, they do, and they also block drilling because the Marcellus Shale actually extends into New York State as well, but they've blocked drilling and fracturing there, so they can't produce it. I know New York, for example, and some New England states are actually, it's not really an import, but they are getting Marcellus and gas and other gas from around the United States delivered to them in the form of liquefied natural gas. So you
So
tell
so
me how it
so
makes
that
sense
natural
to.
gas has to wait. So that natural gas is very inefficient. So it has to get produced what in Texas or Louisiana, and then it goes to an LNG export facility, and then a ship goes all around what the Gulf Coast and the Caribbean, all the way around the East Coast to the outside, and then delivers it.
Yeah,
Wow, that
exactly.
is so inefficient.
So yeah, so it's that's sometimes they rely upon that, when they need to as a supply of gas. So it doesn't make a whole lot of sense, but the point is that gas is going to have to come from somewhere, and I think that it makes sense. It makes sense for a lot of Marcellus gas to end up in New England and also all the way down the East Coast, wherever they can get it. these are high demand areas, fast growing areas. I think EQT is another name we recommend. They are the lowest cost producer of natural gas in the US. They also recently closed the deal to acquire their EQT Midstream, which was their old midstream division, right? And that actually, by bringing their midstream assets in house to EQT, they're actually lowering their cost of gas production even further. They're squeezing uh, more money out of the cost side. So their cost per 1,000 cubic feet is going to be down under $2.
And
Once,
the CEO of EQT also said he wants to build that pipeline down in Northern Virginia, what for Dominion Energy here for the data centers, because he's like a big believer that the data centers are going to be, majority of them are going to be here in Northern Virginia for next generation for artificial intelligence.
yeah, and I think that's absolutely correct. And I think that one of the things that I thought was interesting from EQT's presentation is they talked a lot about the demand growth from the data centers, and um, one of the things that is striking to me is if you look at the government's reports and estimates, they're not showing much growth at all in U.S. Natural gas demand. But the reality, if you look on the ground, is U.S. gas demand is growing very quickly, and it's likely to grow even quicker over the next few years as we roll out, these artificial intelligence, all these new data centers, all this capacity. And so, I think there's a fundamental disconnect there. You've got a lot of people penciling in very low demand growth internally in the U.S., domestic consumption for gas. And a lot of people focus
Is
solely on the export story, but that's only one part
is
of.
that, sorry to interrupt you, are those estimates that are saying that there's going to be less amounts of coal demand, natural gas, oil demand, is that coming from like people who are incredibly anti-fossil fuel and very biased, like the International Energy Agency then?
Some of them are, and this is something we talked about a little offline, I know, but the International Energy Agency. I mean, I'm frustrated. I'm very frustrated by this because I remember back in the '90s, early 2000s, I used to read their reports all the time. I thought they put out a lot of great research. They were founded, to be sort of the foil for OPEC, to represent the consuming countries, to provide useful data on oil demand growth, natural gas demand growth, coal demand growth, to help inform decision making here in the United States and in Europe and other developed economies, Japan, for example. And now they've become political activists.
ESG
So
lobbyists.
yeah, they are. I mean, if you read their reports, they consistently, for example, underestimate global oil demand growth. They do it every year, and then over the course of the year, they revise higher their estimates over time. It's become somewhat of a joke within the industry. You talk to a lot of people, conferences, or that actually follow these things, and you can see that their data isn't accurate. It's always biased against oil, always biased against natural gas. They're now talking about
And coal
um,
too.
coal too. They're now talking about a peak in global oil demand by this decade, end of this decade, a peak in natural gas demand by the end of this decade.
what?
And I can remember not too many years ago, these companies talking about, well, oil demand would never get back to where it was before, COVID. And of course, we were back there, a year and a half later because,
And look at coal demand too. Coal demand hit an all-time high in 2023. It shocked probably. It was probably disproved all those estimates that you just said from the IEA. We hit an all-time high in coal demand for electricity generation. It was solely growth from what, China, India, and other parts of Asia.
yeah, and there's all these, if one of my favorite little things on the internet is you go to Twitter or something and you'll see the EIA or the IEA put out this report and say, oh, well, look, coal demand as a percentage of global primary energy consumption, as a percentage now, a share of global primary energy consumption has gone down in the last 20 years, which is true. But then they say, look at how much, wind, solar have grown. But the reality is that the real trade-off was that a lot of countries have switched from coal to natural gas, right? They're not switching from coal to alternatives. They're mainly switching most of the market share loss of coal. And I'm talking not in absolute terms. You're absolutely correct. Coal demand at an all-time record high. I'm talking about as a percentage of global energy use,
Well, yeah, the
has come
growth
down.
from coal demand is only from a couple countries, though. Yeah.
It's only from a couple countries. And then you have all these other countries which their coal demand is going down because they switched to natural gas.
Yeah, look at the
Not
US. I mean, why do we need as much coal when we have cheap, abundant, cheap natural gas here?
And that's exactly right. And I mean, if you want to cut emissions, if you want to improve the quality of the environment, and I'm not talking about just carbon dioxide. I'm talking about all the pollutants that are associated with coal, from particulates to mercury, et cetera. The easiest, fastest, and least disruptive and most cost effective way of doing that is to use more natural gas and less coal. And that's exactly what the United States has done. And it made economic sense because gas was so cheap. Coal was actually more expensive, right? And you had the environmental advantages. So, of course, we switched more in favor of natural gas, and other countries have done the same. But, the idea that alternatives are taking over the world from coal and natural gas just isn't true. You know, if you look at it, in 20 years ago, fossil fuels accounted for around 85% of global primary energy demand. And I'm talking about just the big three: natural gas, um, oil, and coal. Last year, they accounted for 81.5% of global primary energy demand. 20 years, right? We've gone from 85% to 81 and change.
Well, that's because nuclear power hasn't, it's been right. There's so many red tape and regulatory hurdles. But I think a key point here, and you're saying the IEA data is not reflecting reality. If you speak to the utility companies, the technology companies, Warren Buffett, other value investors like Jesse Felder, who I've interviewed, these people are spending a lot of time looking at companies like Dominion Energy growth projections. I mean, I think this is the first time, Elliot, in decades that the electrical utility companies, there's going to be electricity demand growth, enormous growth. I mean, Warren Buffett has said he thinks that this could be the largest growth industry, growth opportunity for the electrical utility companies in many, many decades based on the data centers.
Yeah, I mean, it may turn out to be the most reliable play of all on things like artificial intelligence because, the fact is that those technologies can't grow without access to energy. Just a few days ago or a couple weeks ago, you know, um, they announced that they're going to be restarting the 3 Mile Island nuclear power plant in Pennsylvania. Now, as you're probably aware, that's the one that everybody thinks melted down back in the, what was it, late 70s, I believe. And the reality is it didn't melt down. It actually was just sort of a partial meltdown. It wasn't like a Chernobyl type thing. There was no actual radiation released, but they're going to be restarting that facility, and Microsoft is going to be buying all of the power from that nuclear power plant because, they need that much power for their cloud computing, their Azure cloud computing business. And they realize that they can't meet their net zero pledge, their pledge to reduce carbon dioxide emissions, solely through wind and solar, which are intermittent sources of power. They need some carbon free, reliable form of constant energy that's 24/7, 365, and that's nuclear.
And I don't
So
see how we can do these data centers like we have to, first of all, for our listeners out there, we have to keep the existing data centers, which are based on like for YouTube and Netflix. So those are like latency and broadband for regular social media and internet usage. And then on top of that, we have to build these larger next generation data centers. I don't see how we can do this without natural gas and without nuclear power.
I don't think you can. And I think that that's the realization is starting to catch on. And that you're definitely going to see the domestic side of the gas story pick up. And I do think there's a lot of validity to the international natural gas story. I look at, and I guess we kind of alluded to this earlier, but you look at countries like Germany, like the United Kingdom, which have cut their carbon emissions, cut their natural gas use in the last, really since 2017 or so. And the reality is that the way they've done that is by engineering a recession. If you look at, if you think about Germany, what's the first thing you think about? At least when I was growing up, it was manufacturing prowess. They made everything from cars to chemicals, right? And they made all kinds of, precision engineered components for all sorts of machinery, valves and fittings and whatnot. And now, their manufacturing industry has been in recession for literally years. Purchasing Managers Index for German manufacturing, which is basically a very widely watched survey of manufacturing companies in Germany. And it's what we call in economics a diffusion index. Readings above 50 indicate expansion, reading below 50 indicate contraction. That has actually been in contraction for 24 consecutive months in Germany. That's never happened before in their history.
And that's
Um,
that's after they had a huge spike in their electricity costs. I think so that 24 months you're saying first they had the Nord Stream pipeline 1 and 2 shut down, which was their cheap source of natural gas, and then their government panicked and started doing importing what other sources of energy that were more expensive, and their manufacturers couldn't compete because the cost kept rising for their electricity.
yeah, that's it. And, as I've always said, energy demand is a function of economic growth. They're two sides of the same coin. If you look at countries that are growing their economy quickly, it's almost always related to relatively cheap or at least stable priced energy. So you have countries that have traditionally had pretty high cost energy, like Japan, but they made the investments in the infrastructure to at least maintain sort of a steady cost for power, for natural gas, et cetera, over the years. And that's what allowed their economies to grow and develop over time. Um,
Well, Japan
Modern
also had
economies,
Japan also had a lot of nuclear power plants prior to Fukushima, so
and they're
they
now
had.
restarting them because they can't afford to continue importing. Japan has almost zero production of oil, natural gas, coal, any other commodity. They're 100% reliant on imports. And they were going to close down all their nuclear power plants after Fukushima, and they've had to go back on that, and they're restarting plants because they realize they can't run their economy without them, without nuclear, without low cost, stable cost nuclear power. And it's the same thing in Germany. They've cut down their they've cut they shut down all their nuclear power plants. The last one shut down, I think, first quarter of last year. Um, they're much more reliant on solar and wind, but the problem, and so you'll see a lot of people say, well, Germany doesn't need coal, they don't need natural gas. Well, they certainly do if they want their economy to grow. As their economic growth started to slump, as their manufacturing sector went into recession, they've used less natural gas, they've used less oil, they've used less coal, but the offset to that is that they have a recession, they have rising unemployment. You're seeing, for example, in Germany, some political parties that were always sort of on the outskirts are becoming more in favor. They're winning local elections, they're winning seats in the European government. And the reason that's happening is there's a lot of social discontent there. And a lot of that has to do with the fact that their economy has been underperforming for now literally years. And, energy transition, meaning moving from fossil fuels to renewables, is really, in my mind, just another word for recession. It's what we used to call a recession. If you want to reduce your carbon dioxide emissions, the easiest way to do that is to send your economy into a tailspin, and then for sure you'll use less of, you use less fossil fuels, and your carbon emissions will go down. But most countries, most governments around the world over the long term are going to struggle to be reelected, right, with the economy in recession on a near constant basis.
And this is not a free market force. This is a government. So politicians, bureaucrats, environmentalists, ESG lobbyists, this is them trying to force energy policy capital allocation into solar, wind, biofuels, electric vehicles. We're seeing this now that this transition is not going well, especially for manufacturing when the electricity costs rise or small business owners, and then the consumer if they get hit with a much larger electricity bill. The other side of this is for transportation there. You're just seeing now a lot of electric vehicle owners in the survey, Elliot. I think it's over 50% of electric vehicle owners that have owned an electric vehicle for a couple of years. They're saying that they want to switch back because the infrastructure is not there. There's all these issues now with the infrastructure to plug in an electric vehicle. So yeah, I hear from a couple electric vehicle owners, oh, I can plug it in at my building. It's fine. There's no line. The majority of people that is not true. The infrastructure is not there for fast plug-in and cheap electricity.
Yeah, and it's also not a silver bullet. My favorite example of this, and I put a chart up on my website and also on Twitter not the other day about this, but or X it's called now, right? But Norway is the poster child for electric vehicles. So in 2023, almost 90%, 89.8% of all car registrations in Norway were electric vehicles. And
This is
over
ridiculous.
80%, yeah, over 80% were battery electric vehicles. And the last, 9 or 10% were, plug-in hybrid electric vehicles. So almost all new car sales in Norway are electric vehicles. I believe they're banning at some point next year. I'm not sure if it starts in January or later, but they're banning the sale of new passenger ICE vehicles, internal combustion engine vehicles. And in 2009, it was less than a quarter of 1% of vehicle sales were electric vehicles. So almost all sales, 99.5+% of all sales of new cars in Norway were ICE vehicles, were diesel or gasoline powered vehicles. Norway's oil consumption was a little over 213,000 barrels of oil a day in 2009. Last year, in 2023, their oil consumption was still a little over 213,000 barrels a day. Their oil consumption has been flat as a pancake since 2009, even though the share of passenger vehicle sales has gone from less than 0.2% to 90% of all sales.
So that means
So
then that the families in Norway, they've bought electric vehicles, but they've kept what their older cars that are diesel or gasoline powered, and so they're using their diesel and gasoline powered cars more than the electric vehicles, would you say?
there's that's one part of it. There's basically two components, right? So you have the families who often have in Norway two cars. So they have a electric vehicle which they use to commute to work. Norway, for example, offered free tolls and free parking if you drive an electric vehicle. And so, people who live close enough to the city center to, have access to charging and the range is not an issue. They drive their electric vehicles to work. But then, when they want to go to their other home or they want to go away on the weekend, they drive their diesel cars, which have much longer range. You don't have the problem of recharging the vehicles. The infrastructure there is an issue even in Norway. So they keep those vehicles for hauling things or for traveling longer distances. The other component, which I think is not well understood in the world at all, is that passenger car sales are only a tiny portion of global oil demand. They're only about a quarter of global oil demand. You also have freight, right? Freight trucks, diesel powered trains, ships powered by bunker fuel, right? You
Which
have
is similar to
airplanes,
diesel. Yeah, similar to
which is
diesel.
similar to diesel. You have airplanes, which are jet fuel. You have all these other sources of transportation which still need fossil fuels. The electric vehicle engines, they're working on them, in terms of developing better engines for use in freight, but they don't have the capability of doing that now cost effectively. The batteries required in a vehicle that size are just too heavy to transport freight over longer distances cost effectively. So, yes, you have companies like Tesla working on it, but it's going to be many more years before electric vehicles are appropriate in those applications compared to passenger cars.
Well,
And then
let's be
you have
honest
the
about the
other,
supply chain with like bringing goods. So if you're a big haul trucker, you're bringing this big rig truck with like food for the grocery store or to
yeah,
Target or Walmart. I mean, like you can't use electric vehicles for it's not reliable to haul very heavy loads. You have to use diesel. The supply chain is built on diesel and reliability moving those heavy loads to the grocery store and to the other big box stores.
yeah, you have to use diesel. And, think about it. Like, right now you have people and, it's annoying, right? You go out to the grocery store, everything costs more. Eggs are up in price, milk is up in price, meat's up in price, right? Everything's up in price. If they have to start using electric vehicles and then add the increased cost of transport from electric vehicles to the cost of all those items, people aren't going to be very happy about that.
Or the shelves
Right.
are empty. I mean,
So
like, can they even do the work? I mean, the electric vehicles, you start
at the
piling
moment,
like
no. At the
you
moment,
start
they cannot. And and it's and then the other side of it is the chemical side of it. A lot of oil goes to make plastics, to make textiles, fabric for people to wear. A lot of it isn't transportation at all. So, people think, oh, well, you have rising EV demand, rising EV use, therefore you're going to have falling oil demand. It's not the case. Just look at Norway.
Well, I mean, that's not the free market. Sounds like it's a government mandate. You have Gavin Newsom, the governor of California, talking about this too, where he's going to phase out fossil internal combustion engine or sales of fuel vehicles by 2030. The free market does not want this because the free market, you need diesel to move the goods. If you want to buy food at the grocery store and you don't want empty shelves and you don't want the prices to go up insanely high even faster than now, you need reliability. You need diesel to move the goods to Target and Walmart and the grocery stores.
And I think that's that's one of the reasons why you're seeing states that are taking that kind of heavy-handed action, right? And California for many years has had um, gasoline prices that are way, way above the national average. They have a shortage of refining capacity in California. They have a specific blend of gasoline that they use there that isn't widely manufactured outside of California.
Oh,
Therefore, it's difficult for
well,
Texas refiners to supply them in emergencies.
Also, in a recession, Elliot, if you go up and look at the major recessions in the US and globally, what, 2008, 9, and 2020, how much did oil demand really actually drop historically in recessions? Did the physical oil demand, did it absolutely crash? I think it only dropped, 5%, at most 10%, and it was only for a short amount of time.
That's
So you had
right.
a brief dip in actual oil demand. But then once people realize, oh my God, the price is too low, people are still going to go to the grocery store. People are still going to want to get on the airplane. People are still going to want to take cruises or drive their car. Then the demand usage starts to pick up again, and then the supply has to respond to that when prices start to rally.
Yeah, that's right. I mean, one of the things I always like to explain, the oil business, of course, is cyclical. The energy business is cyclical. So, there's ups and downs in the price of oil, natural gas, all these other commodities, obviously. But and supply and demand are both a factor in all of those cycles. But usually, a cycle is sort of dominated by either supply or demand. For example, in the 1970s, oil prices generally rose. There were periods where oil prices fell, but generally they rose. And the reason was supply. There wasn't enough non-OPEC supply to meet demand, and OPEC therefore was able to control the price of oil. In 2008, oil prices were at $150 a barrel in July. They were in the 30s by the end of the year, and then they were back over 100 a couple years later, right? And that was 100% demand. There was a short-term drop in demand, but demand cycles are always very V-shaped and very quick. So the economy goes into recession, people consume less energy, businesses close, whatever. But as soon as the economy recovers, then energy demand comes bouncing back right where it was, even higher. Um,
And
and
you get
therefore,
discounts. So you get cheaper if the Fed lowers interest rates, and you start to get cheaper car loans. People go out and buy new cars or
and they all,
switch to
yes.
sport utility vehicles. In a recession, the airline companies start to discount the airline tickets. People are like, oh, I'm going to go on a vacation. Oh, I'm going to book a cruise. And guess what? The oil demand starts to increase again.
So, if you have a recession, you're going to get oil prices come down, no doubt. But it also is very temporary because eventually the economy bounces back. Like you said, prices are low. That encourages demand. People eventually want to go back out and spend money and do things, and the job market improves, whatnot. Everything comes back. The demand comes roaring back. Prices usually come roaring back. Supply cycles are different because, if you have an excess of supply like we did in 2014, 2015, then, you know, demand alone can't offset that. And so you can get these long multi-year cycles, either up or down, where there isn't enough supply to meet demand, and therefore the price rallies for years because it takes years for companies to, develop new projects that can supply more oil. But yeah, demand cycles are usually very short and V-shaped. Supply cycles are what gives you those multi-year expansions or contractions in price. And see, I think what we're dealing with now is a cyclical demand issue in a longer term supply bull market. Because I don't think that, in my view, global oil demand will not peak by 2030. It won't peak probably by 2050. You're going to have decades of growth in global oil demand because even if you're developing countries like the US, like Europe, have flat or even declining oil production because of efficiency or whatever, right? You still have countries like India, which are growing at a very rapid pace and seeing
Oh
very
yeah.
rapid growth in not only in overall oil demand, but in per capita oil demand.
I mean, India and China are building, for listeners out there, insane increases in coal-fired power plants. They're upgrading the existing coal-fired power plants to clean coal. So that's like coal demand and electricity demand. They're building new nuclear power plants. A lot of people are buying scooters and motorcycles instead of walking. So there's a lot
For
of
the
people
first
that,
time. Mm-hmm. Yeah,
yeah,
for the
so you
first
have
time in
all
their
the,
lives.
yeah, so you have all this industrialization, which means more energy usage going forward.
Yeah, I mean, in 2002, 2003, roughly back then, China for the first time in history started consuming more than 5 million barrels of oil a day, right? And they very rapidly grew to become the second largest oil consumer in the world today, right? And really from around 2015, 2016, I think. And you look at India today, just the last couple of years, they've finally grown to consuming more than 5 million barrels of oil a day. India has a larger population than China. It's actually growing faster now. I think that over time, India is going to follow a very similar growth path to China in
You
terms of
also have
oil demand
factories.
growth.
You also have
Yeah, factory,
factories that are
exactly.
leaving China and they're going to India. So India's investing in their energy infrastructure because the factories are moving there. So the job creation, the investment. Yeah.
Yeah, yeah. I mean, and they've been very smart about it, frankly. And for example, when you had Europe not importing oil from Russia or putting embargoes on oil supplies from Russia, India took advantage of the discounted Russian crude and bought more oil from Russia. So, they realize that, they need more energy. I think the government there has been, they are very firmly focused on that issue that, for India to continue to grow as it has been in recent years, they need to make some changes. And one of those changes is to have better infrastructure. They've traditionally had very poor infrastructure, very poor transportation infrastructure, very poor energy distribution infrastructure. And that's changing. And as that changes, the economy is going to do well. Look at the Indian stock market compared to the Chinese stock market, right? It's two different worlds, right? India is going to be a big energy demand growth story, and the world is not going to be able to accommodate the growth from countries like India, continued consumption and growth from countries like China, and the developed world demand without increasing supply over the intermediate term. Nor are we going to be able to see a peak in fossil fuel demand in any time soon, regardless of what groups like the IEA might project and then change after a couple of years of being wrong.
Well, have you seen the
Um,
IEA charts for electricity demand growth with the data centers and artificial intelligence? I mean, they're projecting doubling of electricity demand growth by like 2028. And I don't think they accurately account for the data centers that other countries outside the US, so like China, India, European Union, Japan, are going to be building on top of that. I actually haven't seen any reliable estimates for the data centers that the technology companies and the governments are going to plan to build for next generation ones in China or India. So it's opaque there. I haven't seen any accurate ones. So those electricity demand projection growth ones that everyone has that chart, it's almost parabolic by like between 2028 and 2035 for electricity demand growth. If people are right about like the next generation data centers and artificial intelligence, I don't think they include China and India for the data centers.
no, I mean, in many cases, they either don't include them or, what I see is, ridiculously lowball estimates.
Yeah, they
That's,
have, they have more people with STEM degrees, science, technology, engineering, and math than we do. So they have the ability to do even more technology investments than we do if their government allocates the capital there.
right. Yeah. And that's exactly what they're doing. And, again, I mean, a country like India is very focused on growth and they're very focused on, yeah, as you said, people are for the first time in time, they're buying appliances, they're buying vehicles that require fossil fuels. They're buying or electricity,
That's
which
basic
is
industrialization and a middle class and, consuming more calories and electricity. That's not even doing like the fancy tech stuff that big tech here in the United States has planned.
no, right. No, it's not. And I mean, it's something that's been around. The general pattern has been around. You're right. There are things like AI which are accelerating it. The general pattern, though, has been around for many decades. When I wrote my first book and back in the early 2000s, we had a chapter on there, and I was looking at per capita energy consumption in various countries over time. And what you always see is there's a tipping point, right? When a country reaches a certain level of wealth, the per cap, not necessarily the overall energy consumption, because that depends on population too, but per capita energy consumption skyrockets. So you have a country like the United States, which the average American consumes right around 20 barrels of oil per year. 20 barrels of oil per person per year in the United States.
And isn't it
Um,
like one or less in India? The difference is astounding.
yes, it's under two in India now, and it was under two. It was around two back when I did this study 20 years ago in China. And when you get to that certain level of wealth, people start using more energy. It's just only natural, and it's of course, it's electricity for data centers and internet and basic electrification of their homes. It's vehicles, right? It's
Dishwasher, a washing machine,
yeah.
basic stuff that Americans and people in Western countries take for granted. I mean, that's
Look at air
happening.
traffic in India, for example, right? People are starting to fly there in domestically, which they never used to. There's a wide commercial aircraft industry there. All this stuff requires more energy. Um, and it's natural, and you know you see these Western countries like preaching at countries like India, right? Not to use so much or cut their emissions and all this, but it's a consequence of their growth. So you're asking them not to grow. You're asking them not to develop. You're asking them not to industrialize. You're asking them to keep a huge portion of their population in poverty. And China decided not to take that advice. And I don't think India is deciding to take that advice either, right?
Well, they have exemptions from the Paris Climate Accords for
Yes.
manufacturing and other stuff, so that helps too. I mean, so they can import as much oil and they can do the manufacturing, all the stuff there. So there's just a bunch of hypocrisy with a
Right.
lot of these governments. So if you're a corporation, you're saying we're net zero, but you're allowing rare earth mining or manufacturing in China with like bad conditions and coal and stuff like that, you're hypocritical. They're probably not
Yeah,
counting.
you're importing the energy use from other countries is what you're doing if you're doing that. So yeah, it's just I just to me the long term is bright. As we talked about, I mean, there's some things right now. For example, China has been weaker demand growth lately. And again, I think that's hugely a function of their economic conditions. I mean, we just saw this week, I think the Chinese government kind of panicked and announced a bunch of new stimulus measures. They've done this in the past and it hasn't amounted to much, but maybe this time they're serious. Maybe they're starting to see obviously you can't necessarily take all their economic data at face value because the government obviously controls all that. But there is some evidence that, for example, the labor market unemployment's higher in China than they officially recognize, and that the government realizes that, if things get too bad, they could have social unrest there. But, you know, as longer term, you know, economic growth in China is a function of energy demand, and they're just two sides of the same coin. So I don't see Chinese energy demand declining over the intermediate term. Cyclically, yeah, growth could come down a little bit if there's a recession there or if growth remains weak.
Well,
Um,
especially if they announce like these data center projects, like they want to copy
yeah,
what Microsoft and Google and Amazon and Meta are going to be doing. If there's going to be copycat policies from Chinese tech companies and Indian tech companies and Japanese tech companies and European tech companies, I mean, we're talking like electricity demand growth for the next couple decades. It might set a record. We haven't seen these levels maybe globally, at least out of the U.S. for many decades.
Yeah, and again, I mean, all that just does not add up to a peak in global energy demand or a peak in global oil, natural gas, and coal demand in the next 5 years, 10 years, or 20 years, in my view. Um, and as we've seen, electric vehicles have not proven as popular in, for example, the United States as some of the early boosters would have had you imagine. I remember not many years ago, I think it was 2017 or 2018. I guess that is a while ago now, right? There was a lot of talk about Ford's F-150 Lightning. Now, the F-150 pickup is the most popular car in America in terms of sales. Um, and it was at that time. I think it's been for decades. And they were producing an all electric version of that. And you had all these analysts out there saying, well, this is going to be a huge seller, right? Everybody's going to want the electric version of this car, of this truck. The sales were very poor. They've had to cut production of electric vehicles and shift back to ICE vehicles. Um, you know, it just, the numbers don't add up. You look at an estimate from a group like IEA or even EIA here in the US sometimes, and it doesn't add up to reality. And as you said, I mean, saying that there's going to be flat or slightly growing electricity demand when you're going to try to build out all these data centers to handle the build out of AI, and everybody's bullish on AI, and they're not recognizing that that requires a ton of electricity, literally a nuclear power plant, right? Which used to be a joke, right? It's now that literally is what you need to support that, and saying that energy demand is going to peak or fossil fuel demand is going to peak anytime soon is pure fantasy in my view.
So, in other words, what the electrical utility companies, so Dominion Energy, or the big technology companies like Microsoft and the other Amazon, the other ones, Meta and Google are saying contradicts what the IEA, International Energy Agency, is saying about electricity demand growth and use for fossil fuels.
Yeah, usually, unfortunately, a lot of these groups, these international groups, as I said, have become activists. So they're more focused on, IEA reports are often start out by saying things like, well, this is what governments have promised. And so this is our base assumption. But the reality is that government promises don't always come to fruition. I don't know if you've noticed, but they don't
Especially
always.
with energy policy. I mean, like it seems like that's one of the worst capital
Yeah,
allocations for governments is wind, solar, biofuels, electric vehicles. That the return on investment is either zero or negative if it
or
needs a
hugely
bailout.
negative, right?
Yeah.
And so a lot of these promises and fossil fuel phase out promises and pledges and all that, um, they only last as long as they're politically useful, and then they get pushed out, or some excuse comes up, or a new government takes over and drops the pledge, whatever it may be. But they're not
Or
really worth the paper they're written on. And some of these things are written in such a way that it is. I mean, you could drive a truck through the holes in the pledges. I mean, some of these countries, France, for example, I believe they've promised a phase out of internal combustion engines. I think 2035, I believe, is their latest pledge. But really, what it is that
aren't they restarting their nuclear though? So I mean, they said they were going to phase that out, and they had to restart their nuclear power plants recently too, and they have to invest in those. So I mean, they've already done a
yeah,
180 on that.
they've done a 180 on that, and they're going to have to do more because France actually has done, because most of their power comes from nuclear. That's been a huge advantage for them relative to other countries in Europe. They've have lower electricity costs. One of the reasons that Germany is still, able to keep the lights on is because they can import electricity from France. So Germans have phased out their nuclear power plants, and their nuclear power plants right on the border with France that can export nuclear power into Germany to offset their plants that they decided to close unilaterally for no apparent reason since 2011, 2012. And it's nonsensical. It's kind of the way of the world, but it's nonsensical, and it just doesn't add up. The numbers don't add up. IEA's numbers don't add up with reality we're seeing on the ground. I look at people saying, IEA, for example, saying that the global oil market is going to be vastly oversupplied by early next year. And I look at U.S. oil inventories, and they're very lean. They're about the leanest they've been at this time of year in many years. So how does that add up? That doesn't make sense. It doesn't. The supply and demand figures aren't accurate even in the short term. Yeah, I think the demand issue, if there is one, is a cyclical and short term thing. And then in the long term, we actually have an undersupply problem. Um, if demand is weak, then the world is going to be oversupplied with oil in the short run. Natural gas too, at least in certain areas. But
And
longer
coal and
term,
nuclear power. Yeah, there looks like a if this plays out the way Warren Buffett, the electrical utility companies, the big technology companies are projecting with the data centers, that adds on to a lot of extra demand for electricity demand growth. I mean, we're way under invested in all of these key electricity and energy sources. So oil, natural gas, liquefied natural gas, nuclear power, coal, we're underinvested across the board.
right? And it's a chronic undersupply. It's a chronic underinvestment problem. I think we talked about maybe the last time I was on, the capital spending on the part of your big energy companies. So, your BPs and Exxons and Chevrons of the world on exploration development collapsed after 2014, which you would expect because oil prices and gas prices came down, but it's never really recovered.
And you
Um,
said a bear market for what, 6 years, and then during the pandemic, they had a ton of drilled uncompleted wells, which they brought online quickly, but then they didn't replenish the inventory.
right. And so, there are a couple of companies which, for example, we talked about Exxon, and that's why I like them because they did invest more so than the others during the downturn. But in aggregate, there hasn't been a lot of investment in new exploration development. And so we're behind. A lot of these big international projects, particularly conventional projects, take many years to develop and bring on stream. So you have billions of dollars of capital over many years before you get the first barrel of commercial oil. And in a normal demand environment where oil demand is face it growing, right? Or gas demand is growing, or coal demand is growing, there's just not enough new supply to meet that demand in a normal economic environment. And I think particularly that's the case for oil and natural gas. Now, natural gas is a little easier because there are, some countries like the US, which can grow production very quickly if the price is right. But again, you're not going to be able to have $2 gas and massive LNG exports from the United States. Gas prices are going to have to be much higher abroad to attract US LNG exports, and they're going to have to be higher in the US because most companies can't make money sustainably at $2 gas. EQT can probably break even, but that's about it, right? A company like
I think
Chesapeake,
Antero is
or
pretty cheap too. Antero, I
they
think.
are cheap, but again, those are those that $2 a million BTU figure is the cash break even cost. It does include the capital spending, but that's a level. Basically, that's the level at which they produce no free cash flow. Obviously, over the long term, a company's not going to continue producing at the current rate if they're not producing any free cash flow. They can't pay dividends without free cash flow. They can't buy back stock. They can't do anything to reward shareholders for investing in the company. I think for the U.S. to produce enough natural gas for export over the long haul, right, to meet demand from all over the world, places like Europe, Asia, etc., you're going to need to see gas prices averaging more like 350 to 450. And at that price, you're having companies like EQT, companies like Chesapeake, which I believe once they complete the merger with Southwestern, they're going to be called Expand Energy or something of that nature. Yeah. Their cash cost of production is probably, in the mid twos, high twos somewhere. They're going to be producing copious free cash flow. They're going to be able to pay a huge dividend. They have a variable dividend that goes up when the price of gas, when they have more free cash flow, they pay it out as dividends. They already have a very clean balance sheet, um, and they're going to be able to continue buying back stock when appropriate or when the price is low. So I think that's a good investment opportunity over the intermediate term as well. And I think that gas prices have to be higher to incentive companies to invest and produce gas. They're not going to do so at break even, right? um, Over the long haul. It's true of any commodity, right? When the price of gold was too low, it wasn't profitable to go out and develop multi-billion-dollar mining projects. It's the same with oil and gas.
And we're going to need a lot more liquefied natural gas export facilities going forward, especially if there's a lot of electricity demand growth for a lot of these key countries and the data centers. The key is that if the demand side actually plays out the way that people are projecting, we'll just have to wait and see. You're a true wealth of information today, Elliot. I've kept you for well over an hour. If my listeners want to check out the Energy and Income Advisor or your free, the free market speculator, your Substack blog, how do they do so?
Yeah, well, freemarketspeculator.substack.com is my I put out commentary usually weekly, sometimes twice a week. A lot of it is totally free. I cover energy there, so they're perfectly welcome to sign up for that. As I said, it's free. I also, if you'd like to ask me any questions, you can do so there. I have a comment section you're welcome to post to. Our paid newsletter is Energy and Income Advisor, which is energyandincomeadvisor.com. Kind of a mouthful, but we've been running that now for 12 years. Prior to that, I ran a similar service at another publisher. There we have model portfolios of energy companies. We cover everything from oil, natural gas, nuclear. My colleague Roger Conrad is very much an income expert, and he covers a lot of the electric utilities, also a lot of the master limited partnerships and midstream companies, some of which we spoke about today. So we cover the waterfront really of energy there.
And you actually have growth opportunities now in the electrical utilities, which is shocking. I mean, Warren Buffett has been talking about this a lot the last 9 to 12 months in his Berkshire Hathaway newsletters and his investor meetings. He thinks electrical utility companies, this is the biggest growth opportunity. Excuse me, that he thinks that this is the biggest growth opportunity the electrical utility companies have had in decades, because hasn't electricity demand, it's been pretty much flat in the US for decades, and it looks like that's about to change.
Absolutely. And you look at since the middle of July, the S&P 500 utilities sector is the best performing of the 11 economic sector indices in the S&P. It's up, what's 15% more since the S&P's, mid-July, the peak over the summer. It's by far the top performing sector. There's a lot going on there. And I remember when that was a very sleepy industry, but that's certainly no longer the case.
Well, the industry is considered what, no growth, and similar to bonds with the yield. So they're kind of an alternative for income investors, retirees who want to diversify out of just bonds, U.S. Treasury bonds that used to in the past before the Fed went to zero interest rate policy had a higher yield. So I mean, but now they might be dividend growth and a growth play.
Yeah, actually, they're a play on a lot of things. I mean, one of the things I know Roger's written and talked about a lot is, a few years ago when it was very hot, everybody was talking about alternative energy and all this stuff, and how do you invest in that? And a lot of those companies have crashed. I mean, if you look at a lot of those alternative energy companies, some of them are down 50, 60% from their highs. But, the high quality utilities, which are also having these, solar and wind projects, collecting subsidies from governments, also, building new nuclear or new, in some cases nuclear, but also natural gas facilities, in a fast growing state where electricity demand is growing. They're the ones who are ultimately profited from all that, not these companies selling, solar panels or things of that nature. So sometimes those supposedly sleepy industries are actually the real way to play a lot of these hot growth markets.
Well, the old industries adopt the new technologies, right? So the tech companies, what the pioneer gets shot full of arrows, and the old industry adopts a new
Right, right.
technology and they either add growth or they lower their costs and improve their profit margins and generate more free cash flow. And that appears to be the case now.
Exactly.